On today's episode, we have a great guest, a tax strategist. Besides a tax strategist, he also does a lot of different things. He has many different companies where he helps you build your LLC from start, helps you also, he also wrote many books. He has a lot of strategies that a lot of people are not aware of. And I just been following him for some time now. And every time he always gives the knowledge. So welcome on the show, Ariel. How are you doing today?
Hey, I'm doing fantastic, man. Thank you so much for having me, John and Austin. I'm excited doing this podcast.
Awesome. So let's talk to us a little bit about yourself. How did you start? Talk to us about your background.
So, I'm originally from the Dominican Republic. I was born and raised over there. Came to the States at around 15. Come from family entrepreneurs. My father, basically, he started an auto dealership back home. He used to come to the United States, buy crash cars, and then fix them up and send them overseas. And then we're making a killing. He was one of the first people to do that by utilizing 𝐴𝐿.com and all that stuff. Essentially, he grew enough, but I decided like that. The country enacted a new law that you could only bring so many cars that were like 5 years older and nothing less than that. So that killed our business. So essentially, we ended up moving back, to Philadelphia. I started a couple of businesses with my father, grocery store. Then I started my first company at 18, which was an ATM company. We very successful. We had about like 12 to 15 different spots. Then we sold the ATM company for a good amount of money. And I decided to go back home to the Dominican Republic, thinking that maybe like $150,000 was a lot of money to go back home to the Dominican Republic, but I came to find out that it wasn't. So, that money lasted so long. I tried to invest into a couple of companies, but in my country, if you don't know somebody in the government to facilitate, for your business to be successful, you don't have somebody else who's already successful that can help you, you're gonna have a rough time. So essentially, after that $150,000 come up that I had by selling the ATM company, I came back to the United States with $500. So I had to start all over again. And with those $500, I decided, I was a little bit depressed. So I decided, before I go back to the grind of Philly and starting from scratch, let me go to Miami. So I went to Miami with $500, bought a phone for $150. So I had $350, and then I came to find out that Miami is a little expensive. It was my first time there. And maybe went out one time, paid $20 at the door, and said, I gotta get out of here because I'm about to go. So that was so after that, I tried to get into the dealerships, but that didn't really work out that well. So I decided to finish my degree. Did one last year, got my degree, and then started and got into the banking industry because I was trying to get a real estate loan. Give me 1 second, sir. My dog just walked into my office. Yeah, just let him be there. Just let him be. Okay, sorry.
Okay.
Yeah. So, anyways, where was I? So, I want to get into real estate. I knew that real estate was the best way for you to, build wealth in America, the most secure and real estate that you do it properly. But I keep getting declined for loans. So I said, like, wait, what's going on here? So for me, like, if something's not working, I decided to let me go work for the banks. So I started working for the banking industry. I wanted to figure out exactly how the loans were getting approved. And, so I became a commercial loan officer. I was a vice president for a couple multiple financial institutions. And then I learned how the lending game worked. And what I came to find out is like sometimes I was dealing with companies making like $10, $25 million a year. And they were reporting like $50,000 in net income, $100,000. Like, how's this possible? You guys are not profitable at all. Like, I cannot give you any money. So essentially, we'll have to call the CPAs, the high-level CPAs, and they'll tell me, well, this is what we did. This is how we lower our tax liability on purpose by utilizing the tax code, and they were giving me all the game. So, they kept telling me all the different strategies that, to get those CPAs, you have to pay them like quite a large amount of money, So I got the game from them, and after that, I started getting more interested into, tax planning because as an entrepreneur, it's very hard to make money, right? So that's the toughest part, but it's even hard to keep it. So once I started making money with my different businesses, I was like, I need to keep as much as my money. So that's how I kind of learned about the tax code by reading like 400-page tax returns and finding all the different loopholes.
I think that one thing that you pointed out that was pretty cool is that you were like, okay, I don't, for whatever reason, I'm not getting this loan to be able to move forward in life, or, you know, to go after this particular goal. Let me actually go into this institution and work for them so I can learn the ins and outs, where a lot of people are just like, either, okay, well, if this bank said no, then let me try this bank, or let me try asking, or let me try asking, instead of like, no, let me actually go work for, you know what I'm saying, that entity that I'm trying to like learn from, or learn like how to progress forward. I thought that was actually kind of interesting. I don't think I would have done that.
Yeah, so I did that because I knew I needed more capital to grow a little bit more rapidly with all this, all the plans that I have for my future. So I will start working for a company, and I will get the lending policy. I will study it. It will be like 100, 200 pages. And so that way, when I will propose a loan, either my own loan or our client's loan, it couldn't get declined. Because if I thought it was going to get declined, then, you know, like, I wouldn't even bring it up, or I would tell exactly the customer what they need to do in the next year or so they could get approved. There's not a worse thing than when you go to a bank. You know, you might have large deposits, you might have good credit, but then you have a business and you get declined, even though knowing you can afford the loan, and it will be for a technicality. But yeah, that's pretty much what I did, and then I will use the same rules that the banks had to make sure that if I couldn't get approved, if I couldn't get you approved in that bank, then I don't think nobody else could.
Interesting.
You know what the crazy part is? Like, for the most part, I think when it comes to lending, it's one of those, I don't want to say gray area, but it's one of those areas that people like definitely, like, they see their bank as their
enemy,
keep safe of money, not so much a provider of money. And I think like it's so we're not taught usually to go to the bank to borrow money in order to like progress with and do something with. It's usually something that we hold our money in, or, you know, maybe we'll go there for the loan or the credit card, or like, I'm sorry, like more like a car loan, I should say that, but not so much like, hey, you know, going with the banker, building that relationship. Hey, I have this project that I'm working on, or here's where I'm looking to do with the funds, so you know your money's secure. Like I think that piece is definitely missed, like the relationship building piece, and the intricacies of what it takes in order to get loans where maybe you're not as bankable on paper.
Exactly. And I have this saying that everybody qualifies for a loan. It might not be today, but it could definitely be tomorrow. You know, the right guidance, so you understand how the banks work. Anybody can get a loan, but it's all about how much are you willing to pay for the money. I mean, you can go to the streets, go to a loan shark. They'll give you, you know, as much money as you want for $35,000 in a leg if you don't pay. You know, so it's all about the cost of borrowing that money. But once you understand how the banking industry works and how they lend you, then they're your best friend.
Right. Yeah. And that's
I totally agree. No, and just to Austin's point, like we were never, when I grew up, it was always no, don't get any debt. But once I got older, I changed the word debt into leverage. I'm leveraging the bank's money to make more money. So we just got to change that mindset. So a lot of people have that negative thought of the word. Just change the word and use it to your advantage. Don't use it to buy material things. Use it to take you to the next level in your income bracket.
Exactly. And I, you know, actually went live last night. I was discussing that, like, especially from my country. My mom, she still doesn't understand like why I'm borrowing money to do certain moves, but because she's thinking like she's still in the Dominican Republic. Like, for example, in my country, you want to borrow money for a car, the bank might give you like, I don't know, 80%. You still have to put like 20% of your money, but the interest rate is going to be like 12 to 20%. And people take that because they have no other option. Like, super good example. My friend from childhood, like really hardworking guy, very successful guy. It took him, you know, almost like 15 years to finally get his first car. Not because he had to save all the money to pay cash because he refused to pay like 12 to 20% for an auto loan. While here in America, you have you fix your credit after a couple months. You go to the dealership, zero money down, super low interest rate, 2.5, and you're basically driving the car, you know, like for free for that amount of finance costs.
Right. Right. Let's talk about like real estate? Because how did you now? I know you were serving the corporate clients and just in the bank. I don't remember which field were they like particularly in. Like I know you mentioned some of the companies they were doing a lot of business. What field were they in?
It depends, but I served everybody. What
Okay.
we had was like a segregation. Basically, depending on the sales size of the company, they will deal with me. Like you go to your regular bank and you make less than $1 million gross revenue, most likely you're gonna deal with your local banker or the branch manager. Anything after 1 million in most banks, they're gonna send you to what is called a business banker relationship manager. They specialize in business. So these are the guys that are gonna get you big loans, and they go all the way from 1 million to $500 million and even more. I mean, there's like a lot of different divisions.
Gotcha. Okay. All right. So at least for the purpose of this show, as we get into like some of the now that this episode is going to be releasing during tax time, during tax planning, with real estate being like one of those big like tax shields, like I think people put it like this. People know it, right? We've seen it. Like, okay, real estate is a great tax shelter, right? But they're not yet able to put two and two together yet. So help us put two and two together of what it means when we say that real estate is a tax shelter.
Sure. So the tax system incentivizes entrepreneurship. For example, you own a home on the personal side, you're a consumer. You're buying into that, you're acquiring a property, but it's not really going to stimulate the economy. While if you're a real estate investor and you go and purchase a property for investment, now you're creating housing. Places that people can live, which in turn, like if you have a rapidly developing community, opportunities or whatever, now you're giving more space for people. You're providing quality housing so people can move in, and because of that, the IRS and the government is going to incentivize you because they want you to keep building more houses. Essentially, it might get to a point that maybe we have way more supply and inventory, and they might not get as many tax benefits, but I don't see that happening anytime soon. So because you're helping the economy. And then, you're creating housing, the government's going to give you, they're going to give you a lot of credits.
So let's talk about those and break some of those. Let's get into the juicy stuff. Let's
talk about those credits.
Bring us through what somebody's getting ready to file their taxes, or even if they're thinking about just getting into real estate. What are some of the tax write-ups that they can partake in, and what are some of the things that either you've seen recently just with law change that is, putting things more in the favor of the real estate investor?
I mean, there's a lot, right? Let me see where I can start. So let's start with like passive and income losses from rental real estate.
Okay.
And I think that will apply probably for mostly your beginner investor. So there's something called the qualified real estate professional. So for you to qualify as a real estate professional, you have to spend at least 51% of your time on the year directly with real estate. That is, to managing real estate properties, buying them, flipping them, whatever, or at least spend 750 hours on a yearly basis. Once in the eyes of the IRS, when you're a qualified real estate professional, now you're able to take more of the losses from the depreciation from the property that you buy. Now those passive losses, they turn into active. So for example, let's say you're a doctor, you're making $400,000 a year. There's a cap as to how much you can deduct from the any net losses that come from real estate through depreciation or whatever, depending on how many properties you have. So let's say you depreciated, I don't know, like $100,000 that year. So you're capped as to how much you can deduct from the $100,000 loss because you made more than $150,000, more than $200,000. If you're a qualified real estate professional, now you can lower your taxable W-2 income through those like real estate losses by just being a qualified real estate professional. So you'll be taxed on $300,000 versus $400,000 of your taxable W-2 income. So let's say you're just getting into real estate at the beginning and maybe you're below that threshold. Once you have an investment property, then you can start participating into the incentives that the IRS gives you for when it comes to real estate. So, all the way from the depreciation that you have, you had a loss that actually transfer over to you.
And run us through depreciation just for like the beginners, as far as like what is depreciation?
Okay, so depreciation, if I'm going to talk about depreciation, I'm also going to talk about tax credits. So they're different, right? When you depreciate, when you're taking advantage of depreciation or a write-off, you're lowering your taxable income. So depending on the tax bracket that you're in, let's say you're in the highest tax bracket. I think it's like 39.6% or something like that. Don't quote me on that number. You want to find as many deductions and write-offs as possible to bring you to the lower tax bracket, right? Or if you're a business, let's say you made $1 million a year in gross revenue, you had like, I don't know, $700,000 in expenses. You want to find as many write-offs as possible to lower your net profit, because you're only going to be taxed on the net profit. So when you're taking advantage of depreciation and you're deducting stuff from your taxes, you're lowering your taxable profit, like from the business. Now, a tax credit is a dollar per dollar. It's literally a dollar per dollar. That if you have a tax bill of like $10,000 and you have a $10,000 tax credit, that's $10,000 you don't have to pay to the IRS. If that makes sense.
So is it the tax credits are just fixed, and the deductions, they can vary?
Correct. The deductions, like, I mean, there's a lot of complex different situations. There's also a couple ones that are super simple. Like the famous one, if you work in front of your house and you have an actual business, either a sole proprietorship or an LLC or corporation. Now, for example, this space that I have in my house, I have a whole studio in my house, right? It might occupy, let's say it occupies 1,000 square footage of my house. My house is 4,000 square foot. Right. So now I get to deduct 25% of all my housing expenses, including a mortgage or rental lease, whatever you have, whichever way you're paying your housing situation, plus utilities, plus any other expenses that might arise. Like 25% of that, I'm going to be able to deduct from my taxable income. And everybody can take advantage of this. If you have, especially if you have like a rental property.
Can the normal, like just regular home buyer do that as well? Like just somebody with the single family that just living there as far as like office space?
They have to have if a lot of people are going to be able to deduct certain expenses that they had last year, due to COVID and switching to like a working from home type of situation. But then that's going to depend if the company pay for the expenses. They might want to take the tax credit. They might reimburse you for everything. But if you pay for them, then you can probably claim those in your personal tax return.
Gotcha.
But if you're a 1099 or gig worker, then yes. Like even if you don't have an LLC, and I have a company that called Ready to File that helps you start your LLC, but you don't need an LLC to start partaking into the tax incentives that the government gives you for being an entrepreneur. It's just like you might be limited in some strategies, but you can all those famous posts that people see online, are like hire my kids and all that stuff. You can do that as a sole proprietorship without having an LLC.
Gotcha.
Awesome. All right, so talk to us a little bit about more depreciation. How much can you depreciate, and for how long?
So depreciation, just for the listeners, every building or asset, you can do this with obviously real estate, as we're talking about now. You can do it with machinery if you run manufacturing. And basically depreciation just says that over time, as wear and tear hits the property is going to, in theory, require more work or maintenance to keep it up to par. So because the government recognizes this from a tax strategy, they say, hey, you're able to write off some of what we would expect expenses to maintain that machinery, but in this case, that particular property, with it being real estate. But just go into the numbers of I know it's like 29.6, and you can deduct a certain amount, but you can add it back at the end. Let's do that.
Yeah, so you can do straight line depreciation, which is for residential is 27 years and a half. So you can take the total value of that property that you bought, divide it between 27 and a half, and then that's how much you can depreciate every year for residential. For commercial, 39 years. 39 years, but you have to buy a commercial property. So we'll take 39 years to depreciate that property in full. But there's a strategy called the cost segregation study. Like, let's say when you're taking advantage of depreciation, you're depreciating the property and the land, whatever. But with a cost segregation study, you can pay a company to come in and do a study of your investment real estate property, and then now they're basically depreciating the fans, the paint. Because those items do not take into account for just the structure. So you can appreciate all the fixture assets from the real estate property. And now you get to accelerate almost in some cases, almost 100% of the purchase price of the property if you wanted to, the same year that you bought it.
Really? But so okay, so that answered my first question, because my first question was about to be, is there a cap on how much that you can write off for depreciation? Like, as far as, because if the values are rising, then that number is going to be bigger, but there doesn't seem like there's a cap with how much you can write off when it comes down to depreciation.
So the trick is, when it comes to a non-traditional, you do a cost segregation study, you're actually paying a company to come in and do the study for you. They basically have to go into the property and break it down like fixture by fixture, and then they assign that value. So
okay,
depends on what the study says, and the IRS is gonna go based on that study. God forbid you ever go there, they're gonna check the study and see exactly if it was valid, and then they're gonna do their own analysis.
Interesting, because then at that point, if not, then the easiest way to do it is just take the value of the house and then do the, and divide it by the 29 years.
Yeah, you could do that, but also, you had a really good year, then you might want to take into consideration, you know what, let's do that cost segregation study, see if we can lower the tax.
Right. I don't think people know about the cost segregation study.
Yeah. That's why you need a tax strategist in your life.
So what happens if you write off the whole thing the first year? What do you do for the second year? Do you sell it and buy another one, or?
You technically you can if you wanted to, but you can keep the property. You just won't be able to claim any more depreciation after that.
Gotcha.
Oh, so say that again. So it looks like there is a max when it comes down to writing off depreciation. So
it's a purchase price.
So it's the total amount of the
Yeah, you depreciate 100% of the property in that year, then that's it. You can claim no more depreciation for that property.
But just for that year, though.
Yeah.
Next year as well.
You already claim you already appreciate the 100% of the value of the building. So that's it.
But what is the value? So say, for example, the property is $300,000 and you find a way to write off all $300,000, right? Year one. Year two, property, if it's still at $300,000, then I guess that makes sense why you can't do that. But if the property then becomes $400,000, you wouldn't be able to do it at 400. Like, you wouldn't be able to do anything
because more. It goes based off your cost basis, right? What you for?
Yep.
Gotcha. So that limit is based off of the actual cost basis. Gotcha. Gotcha. Okay.
And talk to us about the tax credit. You mentioned depreciation and tax credit. What credits can you get?
Sure. There's a really good tax credit for real estate that a lot of people don't really take a look at. So if you bought, there's something called Section 45L. So if you're building a new home dwelling of more than 3 floors and up, not including the garage space, and the property is energy efficient, meaning like your contractor has a specific certificate showing that everything that they're building and they're buying that properties is to it's renewable energy related, just like to help with global warming. You're gonna get $2,000 a tax credit per dwelling unit on that property. So you have you're building a new apartment complex, 100 units, and all of those units are energy efficient. There's $2,000 per dwelling unit that you get as a dollar per dollar. Whatever your tax bill is that year is like $2,000 that you don't have to pay the IRS.
And you get that every year as long as it meets those qualifications. Yeah.
Yeah, one time, and I think it expires. You can utilize it all the way to 2021. It's retroactive. I think up to 2018. But yeah, like after 2021, I don't know. They're gonna, depending on whatever Joe Biden does with his new tax plan, they might extend it or it might go away. But I can see him extending it since it's related to renewable energy and being energy efficient.
Let's stir the pot a little bit. Trump or Biden? Who has the better tax policy so far, from what you see?
Definitely for entrepreneurs, I will Trump, hands down. But I still haven't seen his Biden's final tax plan. Now, some of the ideas that he has, they're gonna hurt some business owners. But
why is that?
Talk to us about those.
Well, he's trying to eliminate capital gain taxes. So let's say you sell a property for X amount of dollars. Now, you will only pay like 10, 15, 20%, or you can do a 1031 exchange to avoid capital gain taxes. Now he's trying put that into pay 39%, that's the tax bracket that you're in, like the top of the top, you're gonna pay 39% of the on the gains of that investment property. So we're talking about, like, you know, the max, like 20% or to 39%.
And that was I think I did see that. And that your tax bracket is going to be high. That's within a certain tax bracket. What was that tax bracket again?
Yeah, whatever you fall under.
39 point something, I forgot the number. And he's also trying to raise the corporate tax rate from 21% to 27%.
I also something about trying to eliminate 1031. Is that accurate or is that a myth?
He's trying to change.
Oh, nah.
Yeah. So, but again, it's not final. That's what he proposed when he was running.
I don't even like him proposing it. How dare he? How dare he?
Listen, I don't know. But let's see what's going to happen. But whatever it doesn't matter what happens, though, right? Because for big corporations, they're going to find a way to adjust, and they're going to hire a tax strategist. They're going to have that knows tax law, and they're going to go in and figure out a way to change it to their advantage. Well, they're just going to figure out. That's what we do, right? But like for your smaller businesses that can afford a tax strategist, then you know, they might suffer a little bit more.
Is this the tax strategies that you just talked about? Is this for everybody on the tax bracket? So whether the business or individual is making $30,000 a year, or, you know, 80 million a year, or does that kick in at a certain, like, for example, the capital gains tax? And I might have missed it only because my Zoom froze for 2 seconds. But for the capital gains tax going from like the 15, I think is short term. 15 is short term, and then 20 is long term. Like, so after the 1 year, I believe.
I don't really want to get into the details of this tax one because it's not final, and you know, I kind of stopped paying attention to it until.
I got you. Okay, so but in theory, it's supposed to go up, right? So with it going up, is that affecting? Is that for everybody, or is that for
everybody that has capital gains? Everybody. Everybody that's a real estate investor.
Gotcha. Because I saw something earlier that like, I think he was planning on raising like whatever taxes, and then that was only for people that was or had an income of like 250,000 and above, or whatever the case. But I wasn't.
That's different. That's different.
I got you. I got you.
All right. I want to go back because it was a recent conversation that we're having, Austin. Someone was mentioning regarding depreciation separate between land and building. Is that the cost segregation he was mentioning, or is that a whole different strategy?
So yeah, that will be the cost segregation study. That when they go into the building, like they literally technically break everything apart. We're physically breaking it apart, item per item. Everything that's like a fixture to real estate to the structure, they're gonna depreciate everything, like the plugs in the house, the plumbing, everything.
Got it. Okay, perfect. So that was it. All right. So what's one big tax strategy that you think small business owners are not taking advantage of, besides the one that you just mentioned regarding part of your home that you can write off?
I mean, that's a little bit of a broad question, but my favorite one that a lot of people don't know about is called the 𝐒𝐴𝐤𝐵 loophole. So for 14 days out of the year, you can rent your house to yourself tax-free. So, for example, let's say you know, you want to rent your house, like a similar property in the area that you're in. It costs you $3,000. Your business can pay you as a person $3,000 tax-free without paying any taxes, up to 14 times for the year, as long as you're having you know, a meeting with your team or whoever that is. Could be yourself. Has to be properly documented, and you have to create at least an agreement between you know, you as a person and your business. So now, you know, you're trying to figure out ways to take money out of your business without you're not on payroll, or you want to avoid paying the 15.3% self-employment tax. You can take advantage of the 𝐒𝐴𝐤𝐵 loophole 14 times out of the year, and then, you know, depending on some areas that you're in, to rent a property, you know, like the one that I have might cost me like $3,000 for a day to have a meeting with my whole team for the whole day. So that's $3,000 I'm paying myself directly, tax-free. So
if you have multiple businesses, can you rent it to each business?
Each business. So So, like those little things, they start adding up, for big businesses, small businesses, especially for, like truly small businesses, those couple $1,000s that you lower your tax liability, depending on the tax bracket that you're in, it could be about like $390 for every $1,000, $390 that you're saving. And it's so legal. Like you're basically leveraging the tax code the way that the government wants you to by utilizing all these little loopholes, which I don't really call them loopholes because everything's there. It's just nobody like if you ever seen a publication from the IRS when it comes to taxes, they're complicated. So I can see somebody. It's like reading law. Like you're a law student. I don't know if you ever seen those contracts. I don't understand half of the things they're saying, but I would literally have to read a publication maybe like 10 times, and I will miss something. Like for example, I had a client last year that I saved him about $180,000 from his tax bill. He called me the last 2 months out of the year. And I was in the Dominican Republic, so I was kind of like, done for the year. Like, who's gonna call me to see if I can save them taxes? And I only work based on referrals. I don't, I'm not currently taking new clients right now until I can, if I plan to scale. But it's hard to scale. That was on my brain. But anyways, calls me, had a tax bill of about $225,000. How much money can you save me? All right, give me about like 7 to 8 weeks. So close to the second week before the year ended, we came with a tax plan to save him $180K. And what we leveraged the most was something that a lot of people miss. That, for example, if you want to buy a car for your business, and then that car is over 6,000 pounds, the gross vehicle weight rating, and the gross vehicle weight is not the curb weight. The curb weight is the actual net weight.
Oh my gosh, are you serious? It's down to curb weight versus
gross vehicle weight. But let me break it down. But in the publication, mind you, I've read this publication multiple times because it's a little tricky. So the curb weight, let's say you want to buy I don't know, like a Lamborghini Urus or whatever. The curb weight of that car is about 4,200 pounds, right? So you go to your local CPA. Hey, can I deduct this car and take advantage? Can I depreciate 100% of this car? Because if it's over 6,000 pounds, your regular CPA, whatever, even the dealership will tell you, yeah, it's not over 6,000 pounds. But the trick is, it has to be the gross vehicle weight. The gross vehicle weight of that car, of that Lambo Urus, is 6,200 pounds. So because it's over 6,000 pounds, you can depreciate 100% of the value of that vehicle. We're talking about $250,000. Now you can do that with all the cars, like the Jeep Wranglers, Volkswagens, like Audi Q7. So you can literally go buy yourself a car for your business, for business purposes, as long as you utilize the car for more than 50% for business use. You can depreciate 100% of the car, and you can get yourself a nice car and then save a lot of money on taxes. If you buy like $100,000 luxury SUV and you're in the highest tax bracket, like we're looking at $30,000 to $40,000 in tax savings. So that car that's worth $100K technically will be like $60K, because that will have been $40,000 you have to give to the IRS.
Gotcha. And remember, does it have to be under the LLC, or somebody like personally buy their car and say it's for my business?
It has to be under the business. So I don't really deal much with props. So I don't want to tell you wrong information.
Right.
You should be able to leverage the Section 179. That's what it's called with that car. But it just works better with LLCs because of limited liability. And then, but yeah, like once you have that LLC, then you can take advantage of that. So imagine buying like a luxury SUV and then let Uncle Sam give you a quick discount for it.
And we're about to go into LLCs in a little bit, because Jonathan already knows kind of where I'm about to go with it, because I want to hear your thoughts. Well, yeah, I want to hear your thoughts on it. But I just wanted to break down. I wanted to break down one kind of mathematical scenario just for the on the real estate end with rental properties, because this is where I first saw kind of the power of just writing things off and things like that. Because I was nervous, because when it came tax time and my accountant gave me my worksheet that I fill out, just as far as like reporting, as far as like the rental income that I gave. And then I'm looking at it, and I think like one property was that I was living in the property at the time. So one was like 17 grand or like 18 grand or something like that over the course of the year. So then I'm like, oh crap, like that's an extra almost. So one property was 17, the other one was I think like 22 or 23. And it's like, holy crap, like this is extra income. Like there's an extra almost 40 grand that now I have to claim like on these taxes as far as income that I have to like now pay for it. And I'm like, shit, like I wasn't thinking about that because, you know, X, Y, Z. So then my accountant for the first time like walked me through the various write-offs. And right off the bat, I think depreciation was the biggest one. So it was depreciation was like 11 grand. So now the property that made 17 grand, 17, 18, whatever the number was, now is down to, you know, whatever the case, 8 grand, 9 grand, as far as like taxable income. So then it's like, okay. And then he brought me through the other ones quickly through, you know, run through a couple of the other ones. Like I know the property taxes are, you know, another one. Like, so whatever you pay for in property taxes, you can write that off to lower that number. What else, you know, are those like little line by line that you can write off for, you know, a simple rental property?
I definitely always recommend the you know the Augusta loophole that I mentioned earlier, because like that one is
Okay.
missed by a lot. And then the cost to rent a property in most markets, like a commercial property, it could be a couple $1,000. And you know, you do that 14 times out of the year, it could be like an extra $20,000-$30,000 deduction easily, just for like a regular property. If you have a mansion, now you're looking at like $40,000-$60,000. So you know, I focus mostly on the big strategies, and then you know, I do work together with accountants and all that stuff. Like work together to make sure that, you know, that whatever plan and strategies we're putting together makes sense for the client, and also that it's in compliance with everything, because we don't want the customer to get audited, and if they get audited, we're gonna be able to represent them like every step of the way, like, and show proof as to exactly why we did what we did. But
Right.
yeah, so that the whole when you have a home office, like you're taking everything line by line, those are some of the items. See, your property was energy efficient. You can get a $2,000 credit for it. It could be retroactive for every dwelling unit that you have, and you'll be surprised. Like if it's a brand new construction, most places they know about this tax code, or maybe you install a whole bunch of energy efficient stuff in your house to make it more appealing, and you know, you're leaving $2,000 on the table just by not knowing about Section 45L.
Gotcha. Okay. Now I've been dying to ask this question, John. If you didn't have a question, I'm gonna go straight into this LLC talk.
Go for it.
So, not that it has come to my attention, but more than ever has it now in the forefront, where I just want to like hurry up and get this thing set up so I can take advantage of it. And originally I was buying properties with FHA, which at that point we're using our personal information, and I would have to claim a certain amount on my taxes in order to be able to qualify for the loan. Now that I'm getting those out the way, and now that we're at a point where you know, we're going to start to do the 25% conventional and other methods, at the same time, I don't want to no longer, you know, use my personal income to be able to qualify for these loans to go after properties, because I want to take advantage of the twofold, which is now lowering my tax bill as much as possible, while also dealing with lenders that understand what I'm doing and still can see the money behind the deductions that are taken off, and are able to get loans that way, so that can continue to scale. And we just did another episode with an individual who wasn't in tax, he wasn't an accountant or anything like that, but just businessman that understood tax laws. And, you know, you mentioned earlier the real estate professional, because we do this, we're able to, his fear or his advice is to live completely off of your LLC, right? And while I salivate over the idea of doing that, I'm like, I definitely don't feel like getting audited. Like, I definitely don't feel like, you know what I mean?
Audits are not bad. This is why people have problems with the audits, because a lot of people don't keep records, because keeping records comes with proper bookkeeping. And if you don't have proper bookkeeping, then, you know, you can get in the ass when that happens. But you change your mentality from documenting everything. That's literally all that it is. Let's say you're having a business lunch with John. For this year, next year, that business meal is 100% tax deductible. Before it used to be 50%, you know, because they're trying to help the restaurant industry. So, you know, traditionally you go have drinks, have a meal, just talk about the podcast, talk about business. Because you mentioned business and you were with a business partner, it could be a client or a prospect, then you can deduct that meal 100%. Now, this is what you do. You take that receipt, write down, met with John, met with this business customer, met with this business, even write down the purpose of the meal, scan that receipt, send it to your bookkeeper, and you're good to go. So you have to have a lot of discipline, because I mean, who's gonna be scanning all the stuff? You want to save money, you know, like I scan all my receipts and I write down who I'm meeting with, because it's all about turning all your personal expenses into business expenses to pay less taxes. I mean, that's the name of the game. But you properly document everything, bro, like, and you get audited by the IRS like that, it's gonna be easy. And most audits, I mean, the IRS on average audits only 1.5% of businesses. I think there's like 32 million active businesses in the United States right now, something like that. Only 1.5% are audited. And if you take a look at what happened last year, the IRS is super backed up with everything. You send them a letter, they have a 45 business day wait time to respond to you. That's 6 months. So I'm not saying that you won't get audited this year, but if you do get audited, just have documentation for everything. For example, for the 𝐒𝐴gusta loophole, you have to have that meeting with your team or with yourself. All you gotta do, write a leasing agreement, write down meeting minutes as to what was discussed in that meeting. Just keep those records for like 7 years. The IRS says 3 years, keep records for 3 years, keep them for 7. But if you have proper documentation, an audit is not bad. I mean, people think that they are, and I've been through a couple audits. Like, people think that IRS is gonna come in, knock on your door, like, give me everything. Oh, you're F.
Man, listen, I'm like, yo, I don't want to get caught with Wall Street out here and then trying to start shredding documents.
And that's the funny thing. People that are worried about the audits, they realistically, they shouldn't be that worried, because if you're worried, that means you're not doing anything fraudulent. Like making up documents that didn't exist before. It's like me saying, like, as your tax strategist, you hit me at the end of the year, like, yo, let's say that you have 14 meetings in your house, so you can take advantage of that 𝐒𝐴gusta loophole when you didn't really have them. If you had them and you have the documentation, you're good. You just have to keep records for everything. That's it. That's the name of the game. Document everything.
Yeah.
Don't be afraid of the IRS, man. They're not as bad as you think they are. They're bad if you committing fraud and stuff like that. But so you're good.
Yeah, because right now I'm not taking enough deductions, only because I'm trying to. Well, like I said, like, once this, now that these properties are pretty much done and I don't have to use my personal income anymore, I'm making that transition to do it, to move everything into the LLC now at this point.
So let me ask you this. I don't know, but maybe I'll be able to help some listeners too with this. So when it comes to funding, like, how do you usually, are you self-funded, or you go to the banks? Like, who do you use?
So I go to the guy on the other top of the screen over there for my mortgages, and they'll look at me pretty much the same as they look at everybody, I'm pretty sure, and pretty much income. You know what I mean? Tax returns, credit score, for the most part. So yeah, that's
more on the residential side. So taxable income, what his true profit is, because it's 1099.
Okay. Have you guys heard about the capital markets?
I mean, broad sense, yeah, but I don't know, like, where you're going with it.
Yeah, so the capital markets, that's when you start getting those, like, non-recourse loans, which means, like, with a personal guarantee. Like, you go to a financial institution, get the loans just based on the cash flow of the property, and then you just gotta put, like, at least 20% down. But if you build a relationship with that any of those companies, you can get more properties and more properties. Sometimes you can even just put that 10% down.
And that's exactly where we're heading into. That's where, you know what I mean? Like, that's exactly where it's going, which is why I wanted to take advantage of that while simultaneously lowering my tax bill, like, as much as possible. So that's why I didn't want to, I just didn't want to claim anymore, especially because I just realized the tax laws that are out here, and I'm trying to take advantage of all of them.
Hey, listen, that's what we're here for.
Yeah, I realized that.
I want to backtrack a little bit. I don't know if it's section 179 or which is the one for the car, the one that you. 179. Okay, perfect. Can I finance the car and depreciate the whole thing the first year?
You can finance it. You can lease it. And
lease it too?
If you lease it, as long as you lease it with the intent to purchase. That's
okay.
So you can lease it, but you have the intent to purchase it in the future. Like, if you do that, then you can depreciate 100% of the car.
And what happens in year 2 if I sell it? Do I have to backtrack that depreciation, or how does that work?
Probably capital gains.
Okay.
Yep.
Oh.
There's no 1031 for cars.
No, but
That's actually a good question. That's actually a good question for cars that hold value. That's actually for cars that hold value and actually appreciate in value. Is there anything that lets you swap up or sell and purchase another car without having to?
not right now, but
Not with cars.
not with cars.
No, so basically, you could probably sell it, buy another one, and then offset the gains.
Yeah, exactly. So, but that's
a tax strategist.
But that's not proper. That's like a tax deferment strategy. You buy that car and you plan to keep it. That's probably what I would recommend with the customer, because you don't want to be called like buying a new car every year. And on top of that, Biden is getting rid of that. He's trying to reverse that up there. I think this might be the last year that you can take advantage of buying like a luxury SUV and then depreciate.
Buying a G-Wagon this year.
So you want that G-Wagon, that kind of the Escalade, the whatever is out there new, as a business owner, take advantage of it this year. It might change next year.
All right, so that's where I'm at with this.
Let's talk about LLC forming. Oh wait, talk to about write-offs. All right, so let's say a small business is growing, and they're getting employees. Talk to us about that strategy and write-offs or anything with like taxes when you have employees.
So yeah, I mean, the part of the tax bill, that whole 15.3 self-employment tax that covers like Social Security, Medicare, and stuff like that, that's split between the employee and the employer. So I mean, it's something that's big for last year. There's a section of the IRS that if you're in a disaster zone and you had any expenses related to a disaster, you can deduct those expenses. So for last year, guess what was a disaster zone for in the United States?
The entire U.S.
Exactly. So you as a business owner, you had to purchase anything due to the coronavirus, equipment, any more laptops or anything that you bought for your employees, then you can deduct all those costs 100%. As long as you're in a qualified disaster zone, which is the whole United States.
Yep.
Yeah.
Interesting. So it's just even.
Good thing I haven't done my taxes yet.
Yeah. Yeah. There you go.
Do you recommend? And I always wait to the. I don't know why I always wait to the very end. Please don't tell me there's no like tax incentives for filing your taxes early.
Not really.
Okay, I was about to, only because I always went to not to the last minute, but because we're getting ready to make this next purchase, I'm trying to figure out how to handle things for next year, so that way, I don't mess myself up. But I want to everything get these over with. But I'm actually waiting on just a couple of like things to close to see how I need the claim. So we'll see what happens.
All right, so let's talk about LLC forming.
Sure.
Let's talk about, should a person, let's say someone just started a business, it's brand new. Should they create an LLC for it, or should they wait? Or should they wait? That's the question.
So it depends how serious you are about your business. If you're gonna be all in, and that's gonna be your new form of income, and you committed to grow that business, and you're just making an LLC right away. Now, if you're just getting started, you're not sure if entrepreneurship is for you, which is you guys are entrepreneurs, that it's tough. It's not as pretty as some people make it seem online, all that stuff. You just get started, and then you'll figure it out later. You get started with your side hustle that might turn into a full hustle, and then do the LLC later. But if you're not sure, but if you know that that's going to be your business. Or you have a large risk exposure when it comes to your personal assets. Let's say you have a couple properties, or you have a lot of cash in your account, you have a couple cars that are paid off, then start with the LLC right away, because you want to limit that liability from your personal assets. So because anything that happens with that business, you get sued, they can come after your personal assets if you don't have that LLC. So even that side hustle that you were doing, maybe, I don't know, like washing cars or whatever, and you get into an accident, you're quote unquote like a car they're using for business, they're coming after everything. But if you get into an accident, when you were on that car and you were doing business, and everything's under the LLC, then you're protected. It's all about protecting your personal assets.
I had one question about. I recently found out about umbrella policy. So, what's the difference between an umbrella policy versus having the business in the LLC?
So this is the funny thing, right? Because and this could relate to maybe a question you guys were planning to ask me later. Like how many real estate properties should you have on the one LLC, right? A lot of people always ask me this question. There's no right or wrong answer, right? The truth of it is, if you don't really have proper records or something called piercing the corporate veil, any good lawyer that smells money, they're gonna find a way to tie in your personal life and expenses, like to your business. For example, like you're using your phone for both business and personal, just a couple like personal phone calls can have that lawyer tied into the business, and which enhance will pierce the corporate veil. So it's really important that you keep everything separated. You're truly trying to protect your assets. Now, what can you do to protect yourself from that? So you get an umbrella policy, because an umbrella policy will kick in. Let's say you're getting sued for a large amount, and your regular business policy might cover you, I don't know, $100,000. Your BOB or your general liability policy, like just you have a risk exposure of $100K, and the lawyer suing you for $200,000. The umbrella policy kicks in after that. Right. So that way they don't have to come up to your personal assets. Like the umbrella policy is going to protect you. Or same thing with the car. Like you get into a car accident, you hurt multiple people. Your business auto policy can only cover so much. The umbrella goes all the way to whatever your net worth is and protects you. So that way you get into, hey, like I'm trying to come up to the personal assets. No, the umbrella policy is going to kick in. We don't have anything else. So it protects you even further. More than the LLC.
So yeah, so do you recommend someone that's starting out fresh, should they have a few properties, should they get an umbrella policy or go for the LLC or both?
If you get into real estate, you have a lot of assets. You have a positive net worth. Depending on what your net worth is, it might be smart to take a look at to get an umbrella policy, which is not as costly.
I'm actually looking into it now. It's not much.
You can get one.
I think $1 million coverage. It wasn't much.
Yeah, that might be like $300. $2 million, like $700 a year. It's definitely worth it. But that's what really protects you. Like that's what really protects you from like.
I actually got to finish that. I'm talking to the insurance guy now about it.
What are the step-by-steps to opening up an LLC? Somebody starts from the very beginning. Hey, I want to go get my LLC. What's the step-by-step process?
Well, the first step is if they're ready to file, then they go to readytofile.com. Right? No, I'm just joking.
No, rightfully so. No.
Oh yeah, rightfully. Yeah, go for it. Yeah.
So I mean, they can use our company, but this is the truth of the matter, right? Anybody can open their own LLC, and I tell that to people all the time. I do have that business to facilitate, because for some people might find it complicated. Some people might not find it complicated. Some people don't want to worry about the time of like waiting for that documentation for like 2 to 4 weeks, or getting a registered agent out or some of that stuff. So they could either hire a professional company, or they could go to the Department of Revenue, the Department of State for their state and file it themselves, right? So that's one thing that they can do.
Gotcha. Okay. And then what's like the step? So they either fill out the application or fill out whatever is needed to do. They go to the state treasury, and then the LLC just pops up in the mail a couple of weeks later. That's it.
Yeah, it depends state by state. So most states have gone digital. So let's say on the state of Pennsylvania, like you just go to corporations.pa.gov, search the name to make sure it's not similar to any other names, because it can get rejected if it's a similar name. We take it a step further. Check to make sure that the name is not trademarked, in case you want to trademark it in the future, because if it's trademarked, like they can that person can try to shut you down in the future, especially if they have a nationwide trademark instead of state level. If the name checks out, first you go, you file for the LLC with the state, because this is the thing, the state doesn't really communicate with the IRS. So first get the approval from the state. If your name gets approved by the state, then you go to the IRS to get your tax ID number. Because if the state declines the name for X and X reason, you can still get a tax ID number if that's not taken, but you won't be able to open a bank account because like the names have to coincide. So first you get wait for the paperwork. Some places you get them same day. New Jersey takes like a day or two, something like that. Pennsylvania takes like 2 to 4 weeks, and I think Alabama might take like a month or two. Last I checked. And I mean, just wait for the paperwork on through your email. Some places send through a letter, like New York, and then file your tax ID number. It's as simple as that.
I've seen that a lot of a lot of LLCs have the Nevada formation. Is there any particular? It's got to be something. What attracts everybody to the Nevada one instead of New Jersey?
Yeah,
New Jersey, you said it takes 48 hours.
Delaware too.
Or Delaware. Okay.
This is the main advice that I give people, right? So you a lot of people like to file in Nevada, Wyoming, due to their what is called the anonymity laws. So let's say you're like a large real estate investor, you have multiple properties, and you have a large risk exposure, and you want to put as many layers as possible to protect your assets, right? So some people do. You might hire a lawyer in Nevada, Wyoming. They form the LLC for you, like if they actually own the LLC. Right after it's filed, that lawyer, will give you some sort of legal paperwork letting you know that you're the actual owner. So now that Nevada company is gonna own another company in the state that you're in, and then the real estate property is under Pennsylvania, but then the Pennsylvania LLC is owned by the Nevada LLC. So you sue that property, that lawyer might have passed the bar in Pennsylvania, but they don't have the bar in Nevada. So they have to either work with a lawyer over there, or you might have to hire another lawyer over there. So then that lawyer goes and subpoenas that company to try to say, hey, who owns this company? We're trying to sue them. And on the public records, you can even see who owns it, because the last thing you're gonna see is the lawyer, and once that gets to the lawyer, hey, like we're on contract with that client, so we can release those records. And so it's kind of like open space, and it's really tough to find out who actually owns that property. And at that point, either A, if there's a lot of money, the lawyer's gonna keep pushing and figure it out, or B, like, you know what, they know what they're doing. We don't want to mess with this. And that would probably qualify for your local people that try to fall under your property, like the people that are trying to scam. They hire a lawyer, like, no, we're good. We don't want to deal with that. But so that's why, because they have really good anonymity laws as far as like releasing your public records. Versus a state like Florida, you can find out who owns the company, the address, all that stuff.
All right. Okay.
And when you have an LLC, do you have to file once a year or every quarter? And if it differs, when does it differ?
As far as like paying your taxes or your tax return?
Paying taxes, yeah, paying taxes.
It depends. You can pay quarterly, yearly. I always tell my clients to let's pay yearly. We plan in advance to see what their prospective tax bill is going to be based on what we're forecasting for the revenue, and we'll have a tax plan specifically to lower the tax liability as much as possible legally, right? But if some people might want to pay quarterly because they don't really have a tax plan and they just want to hire But then I'm really against that, because when you pay quarterly and then later you might get a refund or pay less money, they might give you more money, saying like, oh, you have so many deductions, we're going to give you money back. That's interest-free money that the government kept from you that you could have used for other things. So I'd rather deal with the IRS at the end of the year, extend if you have to extend or whatever, versus just paying quarterly and getting the money right away.
Gotcha. So, personal question. I recently I forgot what it's called, but it was basically, I basically have an Amazon store. So I go to Walmart and I have, tax? I don't have to pay taxes because I'm reselling it. Was it?
Yeah, you have seller's permit. Yep.
Okay. So my CPA was telling me that I have to file every quarter. That's if I collect taxes?
I mean, that will be an individual situation. So, I don't want to give like general advice, because that applies specifically to your situation. But probably sales taxes is what he's talking about, like the sales taxes. Because when you have a seller's permit, you buy from the manufacturer, you're showing your seller's permit, you don't pay any sales taxes because it's business to business. Then when you sell to the consumer, that's when you have to pay the sales taxes. So either A, you collect them yourself and then pay. No, you don't. You collect it. You collect taxes. Okay.
Amazon collects it, so I don't have to worry about that then.
So there you go. So then the tax bill for sales tax is passed over to the consumer, and then they send it over. But so that might be a reason why he's telling you to file quarterly.
Gotcha. Okay.
The one of the last thing here is just kind of as we start out this thing here with LLC, because I have one buddy of mine who's like always pushing like everybody to go get their LLCs, like whether they own a business or not. Like they're just like, no, just go open the LLC, just push. Would you like? Is there any advantage? Let's say just the regular 9 to 5 individual. Maybe they don't have a side hustle yet, but maybe, a full blown one, but they have something that, they just sell a couple of things on the side. Do you recommend that they go in LLC there, or is it just like, hey, until you're like up and booming, do you need to open your LLC?
I mean, I'll tell you what I personally do, and I have multiple businesses. I do not get in. I start a company until I have my LLC. Just because, and sometimes some companies I don't even start them just because I like to do things properly right from the beginning, right? So that's not to say that they can like just get started or whatever, but starting an LLC should not be anything more than like $200 to $800 in most cases. Like you do it yourself with like $500 and all that stuff. Even if it's a side hustle, you can work part time on your dreams. You know what I mean? So the LLC might turn into like a full time entrepreneurial endeavor, right?
Right.
Or you have the LLC, you have good credit. It might take you like a good 2 years for you to start getting qualified for for business credit, because banks wants to see you have tenure, meaning that the longer the business has been around, the more likely the business is not going to shut down. So even let's say you started your side hustle, you've been doing it for a year, and you're like, okay, now I'm making money. Let me get on the bank. Let me do X and X. Let me open a bank account, get credit. If you just form your LLC that same year, the bank's gonna ask you, hey, like how long have you been in business? Oh, for like a year or two. How long has your LLC been formed? Yesterday. Yeah, so you started from yesterday. So even though you have like 2 years with your business, like they're gonna count from the moment that you started.
I was gonna ask that question next, as far as like somebody who's a sole prop or my situation where I've been in business for a couple of years now, can show great income, and then if I go to change that over into an LLC, like if I go set that up, will they accept all the previous years? And it seems like they'll just start me off from scratch. Oh, haters.
Yeah. So
haters.
If you have a good relationship with the bank, you can try to make a case, show your your 1040 with a Schedule C, like, hey, look, I actually had this business before as a sole prop. Show them the P&L.
Okay.
You can try to fight that, but in most cases, banks, because they're very risk averse with new businesses, and fairly so, because so many businesses start and people give up because they don't know how to pivot, and also maybe the idea wasn't as good as they thought it was, and because this entrepreneurship is not easy. You know what I mean?
Right. Even if it was just like, hey, like I'm just looking for 20 grand, like I'm not, or 30 grand, or a $50,000 line of credit, business. I'm not looking for, seed funding. It's just like, and I guess if I show assets, won't they, know? Or is it just, are they really sticklers off of like, hey, this is when you started your LLC?
Yeah, the big banks, they are super risk averse. Like, the Wells Fargo, the T banks, the PNC.
Okay, well, that makes sense. I mean, I guess the big banks. I mean, yes, definitely big banks. I would go to a smaller bank or my credit union or something like that for that.
Yeah, like for example, you can get a loan to buy a franchise, right? But you have to have experience in that industry. So there's hundreds of different ways for you to get the money. It's all about like that, knowing where to find it. But in general, like big banks, they're gonna look at you and it's like, you come in, hey, like give me $20,000. Okay, like I don't know you. Like how long have you been in business? Like a year or two. Like I don't know, you're gonna make it. Come back in a couple of years, and then we might give you some money and show us proof that you're making money. So
Gotcha.
Businesses, it makes sense. Like it's like I go to you, like, hey, can you lend me $20,000? What's your business plan? What do you have? Like nothing. I just have an idea. I don't know you, so that there's that reputational risk. Like I don't know you're gonna be able to pay me back. I don't know you have the capital to back it up. So they, instead of like doing a case by case basis, because they're not gonna make that much money in $20,000, they just decline mostly everybody.
Gotcha.
Makes sense.
Gotcha.
Before we go 4 and wrap up, I know we mentioned about starting up the LLC, the cost behind it. What is their cost of having your LLC, like annual costs going forward?
So it depends, right? In the state of Pennsylvania, $0. Here in Florida, you have to file an annual report, which is like $125 or $138.
That's where my LLC is formed, so I pay that every year.
Yeah, so you just file that report. It's super easy to fill out. All the states might be like $200 to $300, $400. So it's not that much for on a yearly basis, like for the LLCs, right?
And that's basically a deduction, no? Can't you just put that as a deduction of holding, like running your business or whatever?
Yeah, it will lower your tax liability. Yep.
I'm just looking at if my bank was like, just part of that and just interested in that. Just caught my mind, so caught my attention. So
all right, before we go to the
Just would
call
love
for
to see.
Austin, you have anything else? Any other questions?
I'm good. No, I'm straight on my end. It's yeah.
All right, so these are the 4 questions we ask all of our guests. Number 1, we could probably change it a little bit, but what is your favorite aspect about real estate or tax planning?
For real estate, because I do have like 7 units that because I bought my first property through an FHA and I bought it in a really good area at a low cost. It was a estate sale. That's what helped me get back on my feet. You know, after coming back from the Dominican Republic with only $500, I bought the right property for like $135K. After a year passed, you know, I was able to do a refi cash out. The property was for like $185,000. So I took that money out and I started started a couple new businesses, and then now I'm here. So that's probably the best way for you to escape your current situation. If you buy a piece of real estate properly, or even to have something like to have that monthly residual income or to pass it over to your kids. I'm a big advocate of people getting into real estate, but of course they have to do their due diligence before investing on a property. It's really tough to lose if you do a good analysis, like when it comes to real estate. So and then you get to participate into the tax system your way to pay less money on taxes.
I love it. Second question is, what is your favorite business or personal development book?
I have a lot. I mean, here in my library, I have probably like 50, 80 books, but like I can tell you the first book that really started helping me change my mindset. A lot of people have read this book, Rich Dad, Poor Dad.
No, doesn't count. Unfortunately,
Give us another one. Doesn't count. Give us another one.
It's the only one that doesn't count on this show, unfortunately. Okay, so you gotta give us another one.
But that's literally when people try to get into entrepreneurship, read that book first.
I agree. 100% agree.
I'll tell you about a book that I'm reading right now that I love. I haven't finished it yet, but it's called Pitch Anything. So everything in life is about sales, and I have read a lot of sales books, but this book actually explains how the brain works, right? So you understand how the brain works when it comes to listening to stuff, then it's very easy for you to properly convey your message to somebody, to like a prospect, I don't know, to your girlfriend or just anybody. And the way the book breaks it down, you know, for years, millions of years, our brain has evolved, like in the last like 5 to 50 million years, into 3 parts of the brain. There's something called the crocodile brain, which is that part of the brain is just activates your fight or flight system, response system. Like, you know, you hear something blow up, right where you're like on your tippy toes, like, yo, what happened? And you're either running or you're trying to assess the situation. That's how we survive for years, like, you know, plenty of years. Then you have the midbrain. The midbrain starts assessing, okay, where the explosion came from, what happened, where is it? Is it an immediate threat? Then you have the neurocortex, which it's about like 80% of your brain. That's where you start problem solving. Okay, like if it's a threat, what are we gonna do to defend ourselves? How are we gonna escape? Are we safe? Like, what are we gonna do? So for years, we're using our brain to survive the wild. Now that we don't really have like a apex predator, like, and no, you know, there's no other animal that's hunting us. Because we have weapons and all that stuff. The brain works a little bit different. So now when you're listening to a pitch or you're talking to somebody, the crack brain is trying to analyze, okay, like, should we pass over this information, let it go all the way to the neurocortex, because we have to protect what is called the cognitive load of your brain. Because especially when you're an entrepreneur, you make so many decisions on a daily basis that your brain can be overloaded. That's when it's 3-4 p.m. and you can't make decisions. So the crack brain is protecting the neurocortex. It's letting you know, okay, should we let this information make it all the way to the crack brain? So, to the neurocortex. So once you understand how that works, which I'm understanding now with the book, I'm probably going to reread all my sales books that I had in the past, because it has literally changed the way that I think. Just like understanding how that works, and it applies to everything.
What's the book called again?
Pitch Energy? Pitch Energy, right?
Pitch Energy? Pitch Energy.
No, but sorry,
Pitch.
Oh, Pitch Anything.
Yeah, there you go. I wrote it.
Pitch Anything.
Oh, Pitch Anything. Oh, by Ariel Morel. I think I've no, I never got this one.
I gotta check that out.
But you know what's interesting? And I'm not even
it's those books crazy. That switch.
Yo, I'm big on that, right? Like, I'm very big on neuroscience and neuroplasticity, and like how like neurons fire together in order to get a desired outcome and all these other things. So like when you Some people call it crocodile, some people call it the reptilian brain, but it's literally the smallest part of the brain. It's the first part to be developed. And I love how you're put like this, because it's usually they take that brain when it comes down to like building like success, right? Or just success habits or anything, just when it comes down to like subconscious and conscious things and things like that. But I love how now we're taking it into a sales aspect where the fight or flight sense is like, hold on, is this too much for me to take on? Like, whoa, like, so I can imagine if, for example, if I'm being pitched on, hey, there's this $10,000 a year mastermind that I want you to be a part of. And if you join, like you're gonna get access, like you're gonna be able to make millions. But because, say, I can afford $2,500 or $5,000 a year mastermind, I might automatically go into the reptilian brain or the crocodile brain, because that gap is so like I'm going back into my comfort zone. So then that information doesn't go to the second brain, which should be the thoughts of, well, no, let's think about this. Like if you put up 10 and if you make 40 in a month, like, isn't that not better? So like now your rational brain, or like you're like, is already shutting off everything before you're even able to like put two and two together of like, no, this actually is beneficial for you if you get over the fear part of it. So I love how like I'm adding this book to the cart, but it's so fascinating.
Yeah,
I'm big on that.
Yep.
That's awesome. That's awesome. Yeah, I feel like anything in life is like a sales pitch. Like you're getting a new girlfriend, you gotta sell her to come with you. You ask someone to marry you, you have to sell them why they should marry you, and anything basically.
I mean, you start doing sales as soon as you're even before you're able to talk as a baby. Like manipulate their parents by crying.
Kids are the best sales people.
Yeah,
man,
and they do it without talking.
Yes, they are. I don't know how these kids always get candy from me, but yeah, they're good sales.
Yeah, but people are afraid of sales because the difference is when you work for like a sales company, and then they don't right away get the desired outcome for X and X reason, because maybe they haven't read all these books and all that stuff, and then they tend to look at it on a negative way, right? But all the successful salespeople, they love sales. But everybody's always selling something, like just like you said with relationships. Like somebody's always trying to get something. Well, babe, let's go out to eat to this restaurant. Show me the benefits. Persuade me to what restaurant you want to go to. You're selling.
Yep.
100%.
That's so true.
Question is, what are some fun things you do in your spare time when you're not helping the world?
I guess as far as hobbies, I like to scuba dive, ride motorcycles, like fast cars, love going fast. Love to travel, haven't been able to do that in the last year. Going back to the Dominican Republic doesn't really count as traveling, because that's home. That's mostly it. Some of the things that I'm doing right now, just like talking about business with my business colleagues. Like I'm very passionate about entrepreneurship. So I'm always thinking the way my brain works. Oh, maybe I can turn this into a business. So a really good friend of mine is always telling me like, no, like stop, like trying to get into everything. Like you have to focus. So that I have a hard time focusing, because it's exciting to start a new business. And
nah, forget him. Forget that.
No.
Comes up in there, start the new business.
I already have too many, bro. I already have too many. Like
yeah, you gotta. No. I definitely agree. It's about. Book it is what is it? The one thing. I think that's one book that focus on one thing and make it grow.
Mm-hmm.
And this is a lot of books put your hyper focus on certain items, because if you're all over the place, you're not gonna grow on the most important things.
Yeah, I think it's the 4-hour work week.
That's one.
Yeah.
St. Iris, that's a good one.
Yeah.
The last question we had is, where can people find you if they want to build an LLC? They want to talk about tax strategy, book you for a consultant. Where can people find you?
Yeah, so I'm right now. I'm not taking new clients for the tax planning, because I'm booked up until like May, until May, right? But this is the funny thing, right? I do have a tax ebook. You go to 𝐶𝐶𝐞𝐫 so on that book, I'm giving like $1,000 worth of game. Like I remember I had an accountant that he called me. He bought the book, and like he booked a consultation. I was like, sure, let's get on the phone. Like I thought I had to defend like, you know, my strategy. He's like, yo, like you should take that down. I was like, what do you mean? I mean, like people charge $15,000 to $25,000 just to like talk about the stuff that's on that book for like $47. And then, but you know, you just have it there because I like to help people. I mean, you buy that book, you can literally, it's going to pay by itself. Like guaranteed, you're an entrepreneur, like making more than $5,000, $10,000 a year, you're going to save like at least like $2,000. And I have people say that have saved like $80,000 just from that $47 ebook. And it has part of what I do, you know, as a tax strategist, just like on that book. So like when people are asking me a lot of tax questions, like I don't like to be rude on my DMs, but like, listen, like just buy the book, trust me, everything's there. You know, I get so many DMs, there's only so many I can answer. But on Instagram, money.morel, and my LLC formation website is readytofile.com. Ready, the number 2 file.com. And you're ready to file your LLC, you go to readytofile.com. I always like have a trick play with the names. And I have my other website, but that one I'm not mentioning right now because I'm not that one's, you know, word of mouth.
Yes, that's a consulting one, right? You mentioned it?
Yeah.
That's referrals only.
Yep.
Yes. All right. One last question. When are we getting another Tax Buddy video?
Tax Daddy?
Tax Daddy.
Bro, I've been busy, but for the other week, I have a lot of ideas. Yeah, like so I have a couple videos that I should be releasing. I might even do one today. Well, they're coming soon. You know, they're gonna come. But I'm just super busy right now.
No,
I got to see this. What's Tax Daddy?
It's hilarious, man. He basically takes good strategies and like makes it funny, like in a meme type of video. It's good.
Oh, nice.
It gets your attention, and you're actually learning as you watch the video.
Yeah, it's like I like to throw a little shock at the end. I mean, I don't know. I'm a clown, bro. Like I'm just
those videos got me dying, man. They're funny, man. Good videos. They're good.
Just have fun with it.
I'm good. How about you, Austin? You have any other ones?
I'm straight, man. Ariel, I appreciate you even taking the time to come on the show. Definitely gave me game. So, you know, just something stuff that I can implement. And I'm hoping that the listeners did too, which if they weren't listening, then it's just, you know, it's one step after the other. And it literally like can save. And I can't like, one last question. But for the W-2 employees, where you know I feel like most of them feel like they don't have as many tax write-off options as the entrepreneurs and the businesses and things like that. But similar to Jonathan's questions about like small businesses, what's one tax write-off that you see people not taking advantage of when they just have strictly you know, their one job, their 1 9-to-5 that they go to?
I mean, it depends on the type of business that they have, but I don't know if I mentioned this earlier, but
this one's when they're an employee. They don't have any businesses.
No businesses.
They're just
W-2. That's the thing, bro. It's not that many things that you can do on the personal level. I mean, before a big one is that you could deduct the interest from a home equity line of credit. They took that away, I think, in 2016, and no longer deduct that. There's not that many things that you can do on the personal level. You know, like just, I mean, this year, Biden's talking about adding, giving a $50,000 when you buy your first house as tax credit, like towards closing costs and all that stuff, increasing the tax credits you get for having a kid. He's raising that amount that you get, but so basically have kids. That's
literally unfortunately it's I didn't think so, but I didn't know if you know just if there were any loopholes just from like my regular W-2, because it's so crazy. Like it was crazy when I first saw just how like I can be matched up to a W-2 employee, pay less, make more, and like keep more. Like it was
no brainer.
Yeah, the biggest loophole is just you gotta start that side hustle, start that LLC, and then even if it's not making any money, like you can start shifting some of your personal expenses towards the business.
Right.
The IRS has something called the Howie Rule for the first 3 years or the 5 years you're in business. You should file taxes every year, right? But then if you're not if your business cannot take a net loss for more than 3 years out of the first 5 years you're in business, And if you do take a net loss, then you have to explain exactly, why you keep going into business and taking a loss. And the reason why is because you can start an LLC, technically have all these business expenses, and transfer that over to your personal income to lower your W-2 taxable wages. Meaning that like the losses from your business can transfer over to lower your tax liability from your salary.
And that's from the net profit or the expenses of the business?
Both. I mean, if you're making money, great. But if when you start a business, it's usual for you to lose money the first couple of years, unless you have like something super profitable right away. So imagine like you're dropping, I don't know, like $20,000, $40,000 into a new business, or like even $5,000. You can deduct most of those costs, to change your personal phone to a business phone, get that car under that LLC. So now
Interesting.
that's probably the best strategy. And if you make money,
interesting.
But if you don't, just know that you have like 3 out of the first 5 years. And anything after the third year, then you have to be able to explain like why haven't you made money? On the fourth year. Like, is this a hobby? Is it an actual business?
Right.
It's a business. So you gotta do is just show your business paperwork, show your business account, show that you're taking payments, but you're just not as profitable. Just be able to make an argument to show why. But a lot of people do that. I mean, like that's.
So just to break it down in numbers and just make sure I understand correctly, you do your business made $50,000 for the year, but it spent $60,000. So your net profit negative 10 grand. Obviously, I believe that you can definitely. I mean, it's self-explanatory. I would expect that you can do the 10 grand and be able to take that from your taxable income on your W-2. But can you do the original 60 grand as far as just that 10 grand?
Just in a loss.
Gotcha. That's what I thought. Okay, cool.
That brings your taxable income by 10,000. Now, the IRS itemized standard deduction is 12,550 for this year. 12,550. So you don't have itemized deduction exceeding that, then you're just gonna take the itemized standard deduction. But if you have a business and you took like a $20,000 net loss, you're not gonna take the itemized standard deduction. You're gonna take the $20,000 loss, because it's gonna lower how much you pay in taxes. It's gonna lower your tax income by 20,000.
Right. And the good part about it is that even if you were in two different tax brackets, 10,000 can be the difference between two different tax brackets. You know what I mean? Like, so yeah, completely understand. Okay, awesome, man. Awesome. I can talk about this stuff all day, man, and just keep on asking questions and because it's one of the most underrated wealth building principles that it's just because I don't think necessarily people think it's sexy because it hasn't been taught to be sexy, but it's not until business people, like, we'll talk about this all day. Like, we think it's sexy because it's just another way to obviously save money, but it's just not taught enough. But so like I said, we can talk about this all day.
Oh, for sure, man. Just let me know. It's not sexy, but it's the best ROI you can do for your business. Like, it's tough to get like 20% of your money. To try to keep 20% of your money, right?
Yes. And the crazy part about it is that you don't have to do anything extra. All you have to do is just have the report and the accounting of it. Like, it's crazy. Like, you're like, you don't have to do anything extra. It's 7 seconds per transaction to record it, upload it, write a note on it, or whatever the case, and it saves you thousands, tens of thousands, 100,000, depending on how much you're making. So yeah, man.
Exactly. That's the name of the game. I mean, everything's there. IRS.gov. Everything's there. You just 77,000 pages.
They put it right there for you. All good.
All right.
Good. I'm straight. Ariel, I appreciate you.
Yeah, Ariel, thank you so much for your time. Appreciate you. We'll definitely stay in touch.
For sure, man. Thank you for having me. I'm looking forward to listening to the episode when it's up.
Awesome, man. Thank you so much. Real Estate Blueprint Podcast signing off.